Hello and welcome to the Tax Roundup for February. Inside this month, we're going to take a look at yet another draft ruling dealing with employee travel expenses. Now, this particular draft ruling overrides any conflicting advice in any previous draft ruling. We're also going to take a look at the Eichmann case. Now, if you remember, this dealt with whether land used for storage was actually an active asset, and in this particular case, the AAT has been overruled. But first up, we're going to take a look at those very significant changes that have now passed Parliament, dealing with the main residence exemption and the exclusion of non-residents. Across to you, Michael.
One of the big changes to legislation in the tax area that's finally passed through Parliament after a long wait are the significant changes to the main residence exemption and how they impact on foreign residents or non-residents. Now, this has taken a while to get there, but the rules are now law. They passed through Parliament, received royal assent, so it is now reality. We will have to deal with this with our clients. Now, those clients that you need, I guess, to particularly be wary about right now are those who are currently non-residents but hold property that they've held prior to this original announcement in the budget back in May 2017. Because those clients have an opportunity to sell their property up to 30 June 2020 and still have access to the main residence exemption to the extent that the property was previously their main residence. Because the new rules, while they do apply on a slightly retrospective basis, there is a transitional period, and that transitional period, which was originally due to end on 30 June 2019, has been extended to 30 June 2020. What that means is that for someone who is a non-resident for tax purposes to be able to access the main residence exemption at the moment, the CGT event needs to happen by 30 June 2020. That means the contract generally will need to be entered into by that time, even if settlement happens a little bit afterwards. Now, this does assume that the person that you're dealing with held that interest in that property from prior to the budget announcement on 9 May 2017. For people who've acquired a property after that, transitional rules aren't going to help them at all. Aside from that transitional period, really the rules in some respects are quite simple. If you are a non-resident at the time of the CGT event, you don't get the main residence exemption. There's no full exemption, there's no partial exemption. The rules don't take into account any previous residency period. It's just wiped clean. If you're a non-resident, when the CGT event happens, you don't get the exemption anymore. Now, that has a number of flow-on impacts as well. You don't get the exemption, you don't get a full or partial exemption. In some cases, people in these sort of scenarios will sometimes receive a reset, uplifted market value cost base for their property, which will help ease the pain a little bit. Unfortunately, for people who are caught by these new rules, that won't happen. They'll be basing their capital gain on the original purchase price, typically, of the property. In addition to that, as a non-resident, you don't get the tax-free threshold, so you're probably going to be paying tax at higher rates. The CGT discount rules have been changed as well over the last little while, which means access to the CGT discount is probably less favourable than it previously would have been as well. Not to mention the cash flow impact of the foreign resident capital gains withholding rules applying as well. So the big picture is pretty nasty for those who are non-residents unless they can access this transitional rule, which is going to end pretty soon. Now, the other change that is worth noting is that there is one other exception to these changes, and it's really based on situations where someone has been a non-resident for no more than 6 years. So you've been a resident for a period of time, but it doesn't exceed 6 years, and you have certain major life events that occur to you or certain family members. That could be the death of you or your spouse, terminal illness, it could be a marriage breakdown scenario. There's a list of specific things that might still give you access to the main residence exemption, even though you're a foreign resident at the time of sale. But it is a very limited exception, and it will only apply to, I'd say, a limited number of people, but something to be aware of. These rules are complex as well when it comes to inherited property, deceased estates selling property, beneficiaries of estates selling property. These rules potentially impact on those scenarios as well and throw a pretty big spanner in the works for certain taxpayers too. Something to definitely take into account as you're working through estate planning processes for your clients as well. So the changes are law. They will have a huge impact on some taxpayers. For those who are potentially affected, we need to really look at whether that transitional period is available. Just be aware, Part 4A is on the table as well. The government has said if you structure your affairs in order to take advantage of the exemption, and really that's done primarily for tax purposes, well, you can expect the ATO will consider Part 4A in those cases. So just be a little bit careful and be mindful of that as you're working through this process with your clients.
The Main Residence Exemption, the new rules webinar is on Tuesday, the 25th of February. It looks at the impact, the exclusion, and the process to get the Main Residence Exemption right. I hope you can join us for that one. Now across to Michael on that draft ruling on employee travel expenses.
Now, about 2.5 years ago, the ATO issued a draft tax ruling dealing with the deductibility and otherwise deductibility of transport expenses of employees. And the whole idea of that was to basically replace, update and consolidate a whole bunch of other guidance that have been issued over the years by the ATO in that area. Now, rather than finalising that ruling, what the ATO has recently done is issue another draft ruling, which is called something slightly different and deals with a similar sort of area, but with a focus that's slightly different to the other draft ruling. What the ATO is saying is that where those two draft rulings are in conflict, use the new one. Right, so the new one really focuses on this issue of whether employee transport costs are deductible or not. And the way the ATO approaches that issue is, first of all, to make some fairly general, fundamental comments around how do we know whether travel expenses might be deductible or not. The sort of factors that might point you one way or the other. So we have some fairly general guidance from the ATO that when you apply it to practical scenarios, you might find it gives you an answer. But beyond that, the ATO then moves into some quite specific scenarios. Some common scenarios, the sorts of things that you'll tend to encounter with your clients from time to time. And the ATO then says, well, here's how we would apply those principles to those scenarios. And the ATO provides a number of examples around that. So things like people who have to travel a significant distance for work. So where that might require an overnight stay, how do we work through those principles in determining deductibility? What if someone is on call or on standby? When would those travel costs be deductible and when would they not be deductible? The ATO also, in this draft ruling, covers an area which is becoming increasingly common, which is people working from home. Really what the ATO is getting at here is to what extent is the need for travel due to a choice made by the employee? So in some cases, when we're trying to determine the tax treatment of travel expenses, we'll look at, for example, is someone travelling to a regular place of work or is it an alternative place of work, somewhere that they're travelling to on an ad hoc basis. Now, if someone works from home and they're not provided with any other office or desk at their employer's office, then we would sometimes try and argue that the travel from their home, which is really their place of employment, to another work site that's controlled by their employer, maybe that could be deductible. Well, what the ATO is saying here is that we need to look at to what extent was it the employee's choice to work from home. If they're working from home because it's their choice to do so, rather than something that's being forced on them by their employer, well, most of the travel they do from that place to any other employer-controlled work site will often not be deductible. That doesn't mean that no travel from home will be deductible, but it does cloud things a little bit and we will need to be pretty careful as we look at that. And you'll find that throughout the draft ruling, the ATO comes back to this idea of employee choice. To what extent is the travel basically forced on the employee by their employer, and they can't really control it, compared with, well, to what extent does the employee really make a decision to be in that location for private purposes? Well, if that's the case, travel from that place will tend to be private as well. So another example, just to give you an idea of how the ATO approaches these scenarios, let's say we've got someone who has taken some annual leave and they're on holidays in Hawaii for Christmas holidays. There's a work emergency and the employer says, we need you back at work straight away. And the employer flies the employee back home so they can start work immediately and fix the problem. Well, what the ATO is saying here is that the employee has chosen to be in Hawaii on holidays. They're there for a private purpose. The travel from that private place to a regular place of work is therefore private and not deductible. Therefore, the employer, if they're paying for those costs, won't be able to apply the otherwise deductible rule. And many other scenarios along those lines are covered by the ATO. Now, for those of you who have been in this kind of space for a while, dealing with clients who are travelling, you know it can be a really tricky area, and probably know that the ATO has been focusing on this quite a lot in recent years. It's a real area of ATO review and audit at the moment. So really important for practitioners to have a look at that new draft ruling, get your head around some of the key concepts and familiarise yourself with some of the common scenarios that the ATO looks at, so that you can then start figuring out how that might apply to your clients' affairs. And you may find that maybe the ATO's approach now is a bit different to what you thought it might have been or how clients have been treating their travel expenses in the past. It's not a final ruling, it's only in draft, but it does represent the ATO's current view in this area, so it's important to be across it.
Now onto that case looking at whether land used for storage was an active asset.
We've had some cases go through the courts recently in terms of the small business CGT concessions, but the one that's probably of most interest to practitioners is the Eichmann case. And this was an appeal by the Commissioner against an AAT decision not long ago, looking at the treatment of vacant land and whether it could be an active asset and therefore qualify for the small business CGT concessions. Basically what the AAT had originally held in the initial decision was that the land used by the taxpayer in connection with their business was an active asset and could qualify for the concessions. Now this land was basically just used for storage. The taxpayer or a related party carried on a business and they needed to store some of their business equipment somewhere. The taxpayer used this vacant land for the storage of those business assets. Now the AAT was satisfied that this land was therefore used in carrying on the business and could therefore be an active asset. Well, the Commissioner didn't like that decision, appealed this to the Federal Court. Unfortunately, the Commissioner has been successful in that appeal. What the Federal Court said is we need to distinguish between an asset that is used in connection with carrying on a business and compare that to assets that are actually used in carrying on that business. Now, that's a bit of a fine distinction to make, but the Federal Court is basically saying that this land did not have a sufficient use in the business. Yes, it was used somewhat in connection with the business, but the connection with the business wasn't strong enough for it to be an active asset. It was not used in the course of carrying on the business. Now, it's not clear how far the ATO is then going to take this Federal Court decision and apply it to real life scenarios. For example, what if there had been a shed constructed on this land and the shed was then used to store the business equipment? Would that make any difference to the outcome? Well, it's not clear. Will the ATO, for example, take this decision and then seek to apply similar reasoning to other areas? Does this impact on interest deductions, for example, for holding costs and other holding costs relating to that land? Well, again, it's not really clear. It's a little bit worrying, I guess, where this is going, but we'll wait and see what the Commissioner says in terms of how they view this decision and what its impact might be. Now, the other thing to be said here is that it's quite possible that the taxpayer might appeal. At this stage, right now, we don't know whether that's going to happen or not. So we'll wait and see. But really important to understand what this means, because there will be people who have seen the original AAT decision and applied that sort of approach and reasoning in applying the small business CGT concessions to assets that clients have held, particularly property. Now, where that's the case, we need to be a little bit careful. Maybe wait and see whether an appeal will be coming or not. If not, or if that's not successful, well, there may well be clients who have to amend tax returns and may have quite significant tax liabilities flowing out of this change to the approach to particularly vacant land being treated as an active asset. So it's a pretty key issue if you do have clients who are holding, using or have sold land, whether it contains maybe a shed or other storage structure. Those are the sorts of things that are in danger here and where your ability to access the concessions may well be jeopardised quite strongly.
And that's the tax roundup for this month. 2020 is going to be a massive year of change. If you need support not only staying on top of those changes inside your practice, but looking at how they flow through to your processes and procedures, then give the Knowledge Shop team a call on 1800 800 232. They'll be more than happy to show you what the Knowledge Shop membership has to offer. We'll look forward to speaking to you next month. See you soon.